Welcome to the InterMarket Analysis video update. This is a video that I do once a week, and I look at a number of different areas. We look at the valuation of the S&P 500, both on a historical basis and looking forward. I also do a pretty intense study between growth and value, because when growth is doing better than value, that has a real impact on the market going higher. When value starts to outperform growth, we see just the opposite of that. The market is typically under pressure. And then I look at other markets outside of the stock market and outside of the S&P 500, because that can give us some clues as to what's happening inside of the S&P 500. No market exists in a vacuum, and they all have some kind of an impact on each other at different times. And taken together, that can give us better insight as to what's actually happening with stocks. This is being prepared for Monday, June 3rd. Now, this video is going to be a little bit longer. Right after this, I'm going to explain the program that I have that is launching Monday, June 3rd. So what I'll do, if you're watching on YouTube, right about now, I will put in a chapter, and you can skip over what I'm going to talk about to go into the rest of this video if you've already heard this or if you're not interested. But feel free to stay tuned to what I'm saying right now as I go through a little explanation of the SPXInvesting Program. I do have this program that I'm launching. I've launched it a few times over the years, and I have some folks that are involved in it. I'm trying to revamp everything and rebuild all the websites and the services and everything that I do offer. But this will be rolled out, and if you want to come check it out, it'll be free for the month of June. Now, I'm setting everything up on Substack, so it will cost you an email address if you want to access all the different things that I'm offering to you. After that, probably in July, is when it will be locked down and it will require a membership fee. And that will be $97 per month. Now, I have, in addition to that, this thing called the affiliate program, where you are automatically an affiliate once you become a member. Now, you can decide, yeah, I'd like to do that, or I'm not interested in that. It doesn't cost you anything, doesn't really change anything unless you decide to take advantage of it. $97 a month may not be very much to some, but it's a lot of money to others. This is a way that you can have your membership taken care of, basically. If you get one person involved, and every month they stay involved, that takes care of half of your $97. If you get a second person involved for every month that they're in good standing, that would take care of the other half of your $97. So basically, for two people, you have a free membership. But you have to be careful with this, because you want to get good quality people. It's not just a one-time shot. It's not something that just happens and, oh, you helped me, now you can go on your way. This needs to happen month after month after month, where they stay in good standing. If they drop out, then that $97 is going to come back, and you're going to be responsible for that. So I want good quality people in this program, and that's pretty much what's happening. I want the best of the best as far as students, because I feel I have the best of the best as far as the program. But this is a way to cover that if you want to do it. And you can even go beyond that. Let's say you have 10 people that you get involved. Well, 2 of those go to pay for your monthly fee. Those other 8 are a way for you to generate income. Again, every month that they're in good standing, then half of that $97 could come to you as a form of income. What does the membership actually include? First of all, starting on Monday, June 3rd, I will be locking down the daily videos. To me, the daily videos are the most important. I do this InterMarket analysis video. I do a weekly video. I do a couple of other weekly videos. Those are going to stay free. So if you just like the InterMarket analysis video that I do, then nothing's going to change, and it's still going to remain free. I'll post it as it is available, and you'll have access. It'll immediately be public. But with the daily videos, once I'm upload those, only members will have first access to those. And that will last until that day's market closes. So for example, it's a Wednesday. I make a video for Wednesday. It'll only be available to members until the market closes on Wednesday. I put a timer on that video. Right when the market closes, boom, that video then becomes public, because there are people that like to watch the daily videos after the market actually closes, even though they're designed to be watched either before or during the market session for that particular day. I do have a series of online courses, and it even goes beyond what I'm listing here, but this is just the main part. Some of you have already accessed the basic course. I have it on YouTube and on Rumble, and it'll stay there. But it's about 3 years old now, and some of the charts are outdated. Now, a lot of the concepts never change. They're true 3 years ago, and they're true now. But I have updated this course, and I will be rolling that out, and that'll be just for people that are members will have access to the updated version. And some of you that are new to the market, you may find this course helpful. Others, it may be just a refresher course. Still others may decide, well, I kind of have already been through this. I know these things already. And then you may want to jump up to course number 2, which is a very in-depth course on technical analysis, looking at charts. I place heavy emphasis on that, and we can really get insight by using technical analysis and lots of different studies. I have my own kind of unique way of doing this that has really developed into a way of having foresight. We can anticipate things happening before they actually happen. And we try to plan for all scenarios at the same time, because there can only be 3 scenarios. The market can go up, it can go down, it can go sideways, and we are ready for those different scenarios at any given time. But this is a long course, and I don't just put the whole course up there. I break it down into modules and sections, and the sections are usually about 20 minutes long each, but they are pre-recorded. You can come back, you can rewatch them, you can ask questions about them, what have you. I also have different strategies. Strategies that I teach and that I implement are, when the market goes up, we can take advantage of that. When it goes down, we can do that. When it goes sideways, we can do that. And so I talk about the theory and the concepts behind all of these different strategies. And there are more than what I'm going to be rolling out immediately. But these are the bedrock, the foundation of the strategies that I like to present in the program. And then the last course will be about mental analysis. And I really go through a lot of psychological things. That's the biggest hurdle that people have to overcome, is dealing with your emotions, specifically fear and greed. And if we can't get a handle on that, what we learn in courses 1, 2, and 3 really doesn't matter, because you're gambling at this point, and you think you have a plan, but you're kind of making it up as you go. The idea here is to let us rule our emotions. We don't let our emotions rule us. Then what I'll do from time to time, and this will require a lot of feedback from members, is I'll take parts of courses 1, 2, 3, and 4 and put them together in a shorter version of the class. And I might just hit the high points in those courses. And they'll be live, where everybody will log in. I'll be in one place, you'll be where you're at, and we'll just do the class together. So members will have an opportunity to attend that. It'll also be recorded, so you can go back and watch it again, or if you missed it, you can go back and watch it, and so forth. And then I'm going to have a community chat room that'll pretty much be open all the time. This is a way for me to post something, you to post something. We can have a little back and forth. You can interact with other members if you like to. If you run across something interesting, you can either post that, or if you have a question, you can ask that. I don't know if it's going to be moderated or not right now at this point. Since I want the top 1% of members, I probably won't have to do that. But if things get really out of hand and people start becoming rude to each other, yeah, I'm going to lock that thing down quick. I want it to be a safe place. No matter what's going on in the world, no matter all the divisions that we see in culture these days, I want people to know that they can come to this room and they're not going to get attacked or made fun of, or it's just a good, safe place for you to be able to ask questions. And you might be really new, and so your questions might be something that another member already knows about. And we want to be nice to each other. We want to help each other. We want this community to be strong. so that all of us can experience success. Because this is one of those things in the stock market where all of us can be successful, but we're not necessarily competing with each other at the same time. There will be online posts available if I run across an article, if something's happening in the market, or this will just be a place that is pretty much open all the time, but I won't be there all the time. I may be logged in, but I might be away because believe it or not, there are times when I need to go to sleep and I might be away. But I just want this to be a central location for people to come to. There'll be questions and answers in this section, but I want to really try to keep whatever you post to keep it limited. We don't need a big, long explanation of things. If you want to do something like that, set up a blog and just share your thoughts with the whole rest of the world. And if you need help doing that, I can show you how to do that. And we want to keep it relevant to the program. I focus on the S&P 500. That's why this is called the SPX Investing Program. We look at a lot of different markets. We keep an eye on small caps, mid caps, gold, the dollar, but ultimately it comes down to how does that impact the S&P 500? So we want to just not go off on too many crazy tangents with this. And then I'll be doing video debriefs. So periodically, specifically, I'll try to do this at least once a week. We just go back and how'd the week go for you? Did you have some good positions, some bad positions? Do you have open positions? How are they doing? Are they seeing profits? Are you seeing losses? And then on an as needed basis, I'll do that. It'll pretty much, the situation will dictate how often that happens. But we may end up having something that's more scheduled. Let's say every Saturday or Sunday at a particular time, no matter where you're geographically located, we come together. And this will also be recorded. So if you miss that, you can go back and watch it. Just a way for us to interact with each other, and members can interact, just throwing around ideas. And then there'll also be live sessions that I do while the market's open. For example, a pre-market open. I used to type up a blog post. I'm thinking of doing a video that'll be available just to members and say, okay, it's been 8 hours since I did the daily video. Things have changed. Something developed. What's going on in Asia? What's going on in Europe? How does the market look to open? And then if it's a really quiet day, that might be the only video post that I do for that day. If it's really going all over the place, there might be a lot of posts, depending on what activity is actually taking place. And then the basis of my program is we usually initiate new positions as close to the close as possible and only in the direction of the strategy, meaning that if we want to go long, we're only going to get into that position if the market is up. If we want to go short, we're only going to get into that position if the market is down. And so I'll set up a room, maybe on Zoom or Skype, and you can come and join. And we're all trying to figure out, is this what we want to do? We get to the point where we enter our orders and we can say, okay, I got filled. Oh, mine's not filled yet. Or I'm not deciding I need another day to decide if this is a position that I actually want to get into. And this is just a way that we can kind of support each other. My personal opinion and experience has been the entrance into a position is the most important. I never buy on dips. I only go in the direction that I want the market to go after I get into a position. And so it's a little bit different. But some of you are going to develop your own style as well. You don't mind if something's pulling back and actually going against you at a given time. You'll still get in where other people may not do that. And this is just a way to kind of support each other. And then I do a series of supplemental videos. I've got a few of those on the YouTube and Rumble channel now that they're public, but I want to do more because some of these areas can be controversial. And what I really try to do in all of my teaching as an educator is I try to present both sides. And if you don't know where I personally stand after I do one of these supplemental videos, then I've done my job, because my idea is to promote critical thinking. Here's the good, here's the bad, here's the positive, the negative, here's the view of one side and the view of another side. Now you decide where you stand on that whole thing. Now, we don't get into a lot of the more divisive areas of what's going on in society right now, but there's controversy going back. Are we going to go into a recession? Are we, what's ESG? Is that a good thing? Is that a bad thing? In different topics. I might read a book, I might run across something, I might pull some things together based on a topic that goes beyond what I hit in the courses and in the videos that I post each day and week, but it's still relevant to the program as a whole. And then this is what a lot of folks are really going to latch onto. Based on the technical analysis that we do, based on the strategies that we implement, we develop what's called a sample portfolio plan and ideas. So we look at all the market conditions and we say, okay, here's 2, 3, 4 different possible positions that you might want to consider getting into. Now, I'm not telling people what to do. I'm just rolling out and showing things to you that are meeting the criteria of what I teach in the course. And then some of you may decide to modify that a bit, or you may follow some of the ideas that I'm actually presenting, but all of that's going to fall on you. I'm not a broker. I can't tell you what to do. I'm an educator. I can guide you to the point where now you can make that decision for yourself. In addition to that, I have what's called the daily journal and action sheet. This is where we write down the market's positive. These are different strategies that we could look at. Ooh, that one looks kind of interesting. These are some notes that we want to take. We know the profit before that we're looking for before we even get in. We know the loss that we're willing to take before we get out. And then different support and resistance levels that we need to keep in mind, different events that may be coming up in the market. We put all of that on this sheet. So we have a plan of action that we know for that day, and it only applies to that day. And yeah, it sounds like a lot of work, but if you want to have good returns, you're going to have to put some effort into it. And then that plan only exists for that particular day. And then we fall back at the end of the day. And then we might rework that plan a little bit for the next day. And then eventually this plan gets executed over a period of time. And there'll be files that are available. There's a blank sheet that is the action sheet that I talk about. And you can download that, print it out. You can fill it out on your computer. I'll also have a PDF of my conclusion, and some of you may come to different conclusions. And that's what I want in this program. I don't want people to just blindly follow what I'm doing. And you may say, I don't really think, I'm not reaching that same conclusion, so I'm going to get in right now, where somebody else may decide to wait. This is supposed to be tailored to you and to your personality. If you want to talk to me about this, now I'm going to have a more private email address that is available to members. This is more of a generic email address, but maybe you don't want to leave a comment. Maybe you want to talk to me about this. Maybe you want to set up a time on Zoom or Skype where we can discuss some things. Those are all options that are available to you. And you don't have to be a member to set up a time with me. And I don't really put a time limit on it. It's depending on, okay, what kind of a schedule do we both have? We want to talk about this for a while. Or maybe we might be able to just text back and forth or email back and forth. There's a lot of different ways we can go with this. Okay, so what I'm doing now is this is where the chapter will go. Now, I can't do that on Rumble. So what I'll do is in the comments, I'll put a timestamp when I'm going over to the rest of the video now, but you can actually click ahead if you're watching this on Rumble. So now we look at S&P 500 valuation. First of all, we look back. This is called a trailing 12 months, and this is historical, and this is really more for informational purposes because the market looks forward. We have 3 lines up here, red, blue, and green dashed line. And these are different PE ratios. And some of you may be familiar with PE ratios already. It's what's the price relative to the earnings that a company's making, because that's ultimately what drives stock prices. Right now, on a historical basis, we're well above the red dashed line. So we're above the 20 level, and that's blown up down below. You can see this just takes current price and then the PE ratio of 20. And so even on a historical basis, we are considered to be expensive. Now, to get more fairly valued, we would have to drop down to anywhere between 11 and 19. That's when it's kind of the sweet spot from a valuation basis. When we get to 10 or below, then either that index or that stock or whatever you're looking at then is considered to be inexpensive or cheap. Here's some different events that have happened going back to 1980 and what the valuations were at that time. The big takeaway from this is we can stay overextended. The stock market tends to be overly optimistic. That's why it has a tendency to go up. And we can be above this red dashed line for years at a time. So this really isn't a timing mechanism. This is just something that we want to know. We can now conclude by looking at these charts that on a historical basis, the market is overvalued. But it's been overvalued for a long time, and it may stay overvalued for a long time. We also use another variation of that using a PE ratio developed by Robert Shiller. This may also be known to you as CAPE, C-A-P-E. I've also seen it as PE10 because he takes more of a smooth approach over 10 years to look at earnings so that the outlier times when they either had a really good quarter or really bad quarter, that's kind of dealt with. So we get a more smooth effect with earnings looking back. The current reading is 34.54. All right, well, what does that mean? We can get some context by going all the way back into the 1800s to see what the market was doing at that time. Like here's the 1929 crash. We have the 87 crash in here, which I guess it's right here, which right now just kind of shows up as a blip, even though it was a massive deal at the time. We have the whole COVID plunge and everything. So we get some graphical context to this. Also, there's the median and the mean to say, okay, the median and mean are between 16 and 17. We compare that to the current number at 34. Wow, yeah, we are overvalued on a historical basis. But we've been almost double what the median and the mean has been for a number of years now. So we don't, sell everything now saying the market's overvalued because it can still last that way for many years at a time. This is another way of looking at PE ratios. This is looking forward. This is based on analyst projections and forecasts that crunch all these numbers and say, okay, this is what the earnings are going to be out into the future. And to give it a little bit more context, the red line is the S&P 500, the blue line are the mid caps, and the green line are the small caps. Right now, as of Friday's close, we're coming in at 20.3. Now that's expensive. That's above that 20 level, but we've been at that level. And when the market has been going up, as it has been doing in 2024, we tend to get a pretty high forward type of PE ratio because we've had some economic concerns and that's really drained on earnings, but yet other companies are doing quite well and the stock market is in more of a positive environment. So we can get up into that above 20 area and stay there. But a little bit of a concern because we are slightly above 20. If you look at the mid caps and small caps, the mid caps are slightly over 15 and the mid caps, and the small caps are just a little bit under 15. And the other area is growth versus value. Growth is buy low, sell high. Value areas tend to perform better when the market is more defensive, getting ready to go down. And it's not that value stocks won't go down. It's just growth stocks tend to lead the market up. Well, they also tend to lead the market down. Value stocks will typically hold up better in difficult environments. First, we look at a peer growth index by itself. And it's been chopping sideways for a lot of 2024, but we are in an uptrend. We came right back down to the 50-day moving average when we look at this index all by itself. So it's looking good. And then we also look at a value index, which also is in a longer term uptrend. We fell below the 50-day moving average, but in Friday's session, because value really got hit earlier in the week, this past week, we came right back up to the 50-day moving average. Okay, so that's interesting. Do I want to be in growth or do I want to be in value? The real usefulness of studying this comes when we start to do ratios between the two. We go growth versus value. And for a lot of the most recent time, growth has been outperforming value, but it was really starting to outperform, even though the market was going down this past week. But in Friday's session, we saw that ratio really dropping down as value saw a little bit of opportunity for people to come in and buy. I do inverse versions of these same charts because you can see there's a little bit of an offset when we saw this moving average crossover. Sometimes we can see things when the chart's flipped upside down that we don't necessarily see by just looking at the chart itself. And I do a lot of different versions of growth versus value in this video, and I keep an eye on them. Here's another one. This is looking at some ETFs, growth versus value, longer term. This goes back to 2004, showing that for the most part, growth is outperforming value. So that's more indicative of a buy low, sell high type of an environment. Here's an inverse of that same chart showing how value is underperforming growth. Then here's those same indexes that I showed earlier, but this is longer term. And we've been chopping around a lot in 2024, but growth is still in the longer term outperforming value. Now, on a shorter term basis, we've been a little bit concerned about this. We're seeing value areas that usually are more defensive that the market typically will get into when they were getting ready to go down. And that's causing us a little bit of a concern right now. And I'll show you that as I go through the video. Here's another ratio between the two. This is value versus growth, showing how value is underperforming growth, and another showing how growth is outperforming value. And we're not necessarily seeing that big move down in Friday's session that we see on some of the other charts. Here's some ETFs, and I've been showing this pretty much in every daily video because we're keeping an eye on these two ETFs, and we actually broke outside of the rainbow, but then we saw it pull back in Friday's session. But overall, growth is still outperforming value. This also shows how value has been underperforming growth. Then we break it down a little bit more. I look at it just for the small caps. Now, I don't personally participate in the small caps, but we still want to keep an eye on that market. That's part of InterMarket Analysis. And we're a little bit concerned here, or disappointed might even be another word, because typically when this ratio is going up, that gives more support for stocks to go up. Well, 2024, we've been range bound with the small caps. We hit the high end of the range and then we go down. We get to the low end of the range and we start going up. And it's been really choppy. It's the main index yet that has not set a new all-time high. We need a more friendly economic environment for the small caps to do better. They don't like rising interest rates because typically smaller companies have to borrow. And when they have to borrow at higher rates, that bites into their earnings. So we're a little bit concerned about the growth to value ratio here as of right now. We also look at for the mid caps. Now, this had been holding up a lot better earlier in 2024 and even back into late 2023. But we saw this really dive down in Friday's session. We want to see this going up. The mid caps have actually been one of the stronger areas of the market, especially since the latter part of January. You see, we started off 2024 sideways, and then we broke to the upside. And there are some times when this is the best looking index of the whole bunch when I rank them on their technical score, but they've been under pressure lately, and the growth to value ratio hasn't been doing all that well. The one that I really focus on is S&P growth to value. Now, this ratio can be going up, and the S&P can be going down, and this ratio can be going down, and the S&P can be going up. So it's not a pure one-to-one relationship, but we want to see this really continue to go up. That would be more positive for the S&P 500. And even though it's been showing some improvement over the past few trading sessions, we're not really breaking out of these previous levels that we were at when the S&P was at a lower price. We keep an eye on inflation. I have a monthly chart of the CRB index, which are commodities, and we're above the moving average, and the moving average is also going up. So that index is in an uptrend. Then we do a ratio between inflation and deflation, and we're below a declining moving average. So according to this, inflation is not necessarily a problem right now. We have seen it really pick up, but it's not what we've seen historically going back to other times. As long as we're continuing to decline here, when we're looking at commodities and this ratio, this is not really giving us any concerns on a longer term basis with inflation. Here's a daily chart of the CRB index, which is in an uptrend. And when this really gets moving, sometimes that can actually help the stock market because everything's going up. Other times this can be seen as inflationary. We have the breakdown of what's inside of the CRB index to give us an idea of what's actually being measured here. And we look at the Baltic Dry Index, and as a very general rule that always has exceptions, this is what does it cost to ship products from point A to point B, specifically in the Baltics. When this is going up, that tends to be more inflationary. When this is going down, that's more deflationary. Well, we've been chopping around quite a bit, but we're still in an uptrend here, even though it's not a real strong uptrend with this. And we keep an eye on some other markets. And this is usually, unless something's really happening, about the only time each week that I look at these markets. This is aluminum, which is in an uptrend, and that could potentially be inflationary. Here's corn, which is in a downtrend, but it has been bouncing up lately. If this continues to go up, that could be inflationary for food as well. Wheat, the same thing. It's starting to really bounce back up. And at some point, if this really keeps going, that could cause some concerns for the market. There's fertilizer, because that's the foundation of growing things. Where over the last few months, this is a 3-month chart, it really hasn't been changing all that much. So we're not seeing any big spikes up in price here. Oil, which is still under $80, it spiked up when things were really escalating in Israel. But since that time, it's been pulling back, and we actually closed just under 77 in Friday's session. Gas, this impacts all of us when we have to fill up our cars. We're in an uptrend, but gas prices have been coming down, which is a common political ploy. We had Memorial Weekend a week ago, and a lot of people are driving. They're going to the beach, they're going to picnics, they're going to different events for Memorial Day. And so they're trying to do things. Plus, this is an election year, so we have all these games that are being played. They want gas to go down because this is something that is really felt by people directly. Every time you go to the pump and have to fill up your vehicle, it's like, oh my gosh, gas prices are going up. I don't like this. Or gas prices are going down. Ooh, I like this. Then we look at diesel, which has also been declining lately throughout April and into May. This is mainly for 18-wheelers and railroads that have to ship products around the country. Heating oil, which, it's summertime now, so there's not a real need for heating oil, but this can still dance around no matter what time of year it is, but it's in a downtrend. Natural gas, which has really been under a lot of pressure, has now been bouncing back up a bit, but it's still in a downtrend. Copper is another thing that we keep an eye on. And I know there's Silicon Valley and we do chips a little bit different now, but copper is still used in a lot of manufacturing. And so they call it Dr. Copper. And as a general rule, when copper is going up, that means the economy is looking better going forward. When copper is going down, that could suggest economic weakness. Copper's been just screaming to the upside and just breaking out to highs here, but we've been seeing some profit taking recently, but it's still in an uptrend. Then we look at copper and we do a ratio between copper and gold, showing that copper has been outperforming gold, even though it's been pulling back. We've seen a recent golden cross here showing that that copper is continuing to outperform gold. This is a longer term look at that same chart. That's the black line here. And just to give it a little bit more context, I plot the 2-year and the 10-year yield on here. We see these are very far apart from each other. Where if you look from 2012 up to about 2016, they didn't get that far apart, even though they're on different scales, and they were moving in the same general direction. We haven't been seeing that now as we're seeing economic conditions change over the long period of time. Here's looking at gold. Now, this is not the futures contract. This is the gold ETF, where it is in an uptrend, but we've pulled back down to the 50-day moving average. Silver is also in an uptrend. It hasn't come down to its 50-day moving average, but it has been pulling back lately. And we look at the closing price for gold on top, which has been in a recent decline because it's the craze. And you've got these gold bugs out there that have literally for decades been dreaming for what's happening right now and saying for decades what's happening right now was going to happen years ago. Now that it's finally starting to happen, this is like the best of all worlds for them. And then we have the closing price for silver, which has been pulling back recently. And then on the bottom, we look at the correlation between the two. Usually it's pretty strong, and that makes sense. If gold is going up, typically silver is going up, but sometimes they get out of line with each other. We've actually been seeing silver hold up a little bit better. It's more in a range where we're seeing a little bit more of a decline here with gold. You could also see that the other way around as well. But now we just have a chart that tells us how strong this correlation is. And we have a gold to silver ratio on top. When this is going up, that means gold's outperforming. When this is going down like it is now, that means silver's outperforming. And then we plot the US dollar index down below. and we look at the correlation between the two. Now, I personally don't use this to make decisions, but we can get some insight. As a general rule, when the dollar index is going up, gold tends to outperform silver. When the dollar index is going down, silver outperforms gold. Just some observations that we can make. And this is not a hard and fast rule. This is just a general relationship between the two. And we can see the correlation on the bottom. Here's the dollar. We have been keeping a close eye on this. A stronger dollar can pressure stocks because of the exchange rate, because of when they're doing their accounting. It looks better when we have a weaker dollar. And even though it's been pulling back, it got up into the 105 range. And then on Friday's session actually closed into the 104 range, but it's still in an uptrend when we look at the daily chart. It's also still in an uptrend on the weekly chart. There's another look going back a little bit further, where for a long time we were not able to break out above this trend line. Now we broke out above it, but we've been trailing off after that breakout. We keep an eye on the euro. We just have a chart of the euro on top and the dollar index down below. Then we plot the Japanese yen, the euro, and the dollar all on the same chart to get, and I don't have any studies on here. I just kind of want to look at this individually. I'm sorry, look at this taken together. The next chart is where I look at it individually. This is the euro to the dollar, and it's in a downtrend compared to the dollar. We also look at the Japanese yen, which is also underperforming the dollar. But when we look at the British pound, even though we're seeing these lines not all that far apart, the British pound is still in an uptrend when compared to the dollar. Then we look at some different indexes, and I show this in the daily chart. This is the S&P 500, which is a weighted index, and we compare it with an equal weight index where all stocks are treated the same. When the red line is going up and actually outperforming, that suggests more broad market strength. When the S&P weighted index is outperforming the equal weight index, that's the big companies. That's a Magnificent Seven. That's NVIDIA. That's Microsoft, Amazon, Google. Those stocks are outperforming the rest of the market. And this is another way of looking at this as an equal weight to S&P ratio. When this is going down, that means that the big stocks are actually outperforming. When this is going up, that's when we're seeing more of broad market participation. And then I have a chart that's similar to that. This is from Isabel Net blog charts. This is that same ratio, but they have some different areas that are here. And you can take this as positive or negative. We watch the weighted indexes versus the broader market on a lot of different studies that I do on the daily video. And to try to reach a conclusion based on what's happening here, that changes every day, but we do keep a close eye on that. And we look at a ratio between stocks and commodities, where even though they've been pulling back, stocks have been outperforming commodities. We did see some weakness back in April here, but we've been able to bounce back up with this ratio. Here's an inverse of that same chart showing how commodities continue to underperform stocks, even though both are in uptrends. Here's the NASDAQ 100, the real leadership area of the market. These are the Magnificent Seven stocks, and we compare it with the S&P. Now, both are just coming off of setting recent all-time highs, but this ratio is showing that we were seeing some weakness, where the NASDAQ 100 was starting to underperform the S&P 500. But then, as we were coming back up in May, we saw this show an improvement. But over the last few trading sessions, this has pulled back, and we're kind of in between right now when we look at the trend of this ratio. What would really help the market right now is for the NASDAQ 100 to kick back into gear and actually outperform the S&P. And here's the S&P 100, which pulled back in Friday's session, but for the most part, the biggest stocks that make up the S&P 500 have been outperforming. Here's the NASDAQ to S&P 500 ratio, also showing that the NASDAQ is outperforming the S&P. The NASDAQ 100 compared to the NASDAQ itself. This is interesting. We're actually seeing a death cross here with this ratio. That means that the NASDAQ has been outperforming the NASDAQ 100 on a ratio basis here. And that might be a concern to some people. They want the NASDAQ 100 to always outperform. And sometimes when it starts underperforming, that might suggest some weakness going forward. We look at the mega caps and compare it to the equal weight index. Mega caps are the big monster companies, and they typically have been outperforming, but we saw a bit of a pullback late last week. We look at a ratio between small caps and the S&P 500. That's the red line. And this continues to go down and at best just chop sideways. Eventually, the market's going to want small caps to do better, but we need a lower interest rate environment for that to really happen. And the trend of interest rates has to be going down as well. And this is putting a little bit of pressure on the markets for right now because the small caps have been lagging behind. And then we look at a ratio between the small caps and the S&P, and this continues to show how the small caps are underperforming. We saw a real spike up here back in November and into December. That's called the January effect. But once we hit 2024, boom, that ratio just stopped. And then we look at the biggest software companies. This could be a little bit concerning. We've been really going up with the market, but these big software companies are not doing all that well. They're still in an uptrend, but they've been underperforming for most of 2024. The mega caps, this is what everybody's talking about. This is what everybody loves. It's in a solid uptrend, even though it pulled back over the last few sessions. But this is where the real strength of the stock market is coming from. Robotics and AI. This is all the buzzword. Everybody's talking about it. This is taking that ETF and looking at it individually. Not doing all that great right now. It's coming back down into the rainbow. And then we do a ratio where we take the AI ETF and compare it with the tech sector, showing how the robotics and AI are actually underperforming the tech sector. Even though this is all the craze right now, we're not seeing a real follow through when we would expect to see the robotics and AI ETF outperform, but it's not. Here's the Dow Jones Composite Average, where we take the Dow, the transports, and the utilities and put them together. In much of 2024, a lot of the strength in this average was coming from the Dow. Lately, the Dow's been under some pressure, but now we've been seeing utilities doing a lot better, and that's why we're seeing this in an uptrend. The transports, the middle area, that has been a real disappointment, but it hasn't put a big drag on this composite average either. There's S&P 500 to shorter term bonds. When we're up outside of the rainbow, that means stocks are outperforming. Then we look at the S&P 1500 and compare it with short-term bonds, also showing that stocks are outperforming. We look at another broad market measure and compare it with 3 to 7 year bonds. So we go a little bit further out. This is showing that stocks are outperforming. This is a total US stock ETF made up of 2,651 stocks. And we're coming down, but we're coming down to the 50-day moving average, but we just recently set all-time highs. And this is a really broad market measure. We look at low volatility stocks. These have been in an uptrend when you look at them by themselves, even though they pulled back recently. But when we do a ratio between low volatility stocks and the S&P, they are really underperforming. And this ratio has really been declining since late 2022. And then we look at the tech sector and compare it with bonds. It's falling back after Friday's session, but is still outside of the upper end of the rainbow. And then we look at an advanced decline line study, and I typically show this in every daily video. We go across different indexes. Here's the common stock where we came down to the moving average and bounced up off of that. That could be positive. We're seeing that same bounce with the S&P, the mid caps, and the small caps. So we were showing some weakness as the market was going down, which only stands to reason. But in both Thursday, even though that was a down day, and Friday session, which was an up day, we saw these advanced decline lines actually go up, and that's more positive for the market. We look at Dow theory, and this is traditional Dow theory. When it was first developed, you look at the Dow on top, and I think it was railroad stocks that they used, because that was the high tech of its time. Now it's developed more into the transportation index, where the Dow had set an all-time high, but has really been under a lot of pressure as some of the earnings reports that are coming out are not as friendly as the market would like. The transports have been a real disappointment, but they did bounce up in Friday's session. The utilities have been a surprise. Now, I include utilities as part of traditional Dow theory, where a pure Dow theorist would not necessarily do that. We're looking for confirmations or divergences. And we've seen this, and the perma bears are latching onto this, but this has gone on for a while, where the Dow is setting all-time highs, but the transports are lagging behind, and that would be a negative divergence. And that's true, and it's been there, but it's been that way for a while, and the market is not falling apart, at least yet. And the utilities getting stronger, that's a defensive area. we've saw some profit taking, but if utilities tend to remain strong, that's a bit of a concern to us. This is what folks get into when they're turning more defensive on the stock market. Here are other transports all by themselves, showing that they just are languishing sideways. They actually broke a little bit lower. We have not been able to get back to highs that were set in 2023, nor the all-time highs set back in 2021. And we do a ratio between the transports and the S&P. This has just been declining, even though it bounced up a bit in Friday's session. We look at another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, but it did fall back a bit on Friday. We look at the correlation between the S&P on top and the transports, and they have kind of a strong relationship now, but when we get up into the top area of this red box, that means they're going in the same direction at the same time. Doesn't mean the direction they're going, it just means they're going in the same direction at the same time, either up or down. And then this is a new idea behind Dow theory, where instead of using the Dow, why don't we look at the S&P? That's a better representation of the U.S. economy. And instead of looking at the transports, why don't we look at the NASDAQ? That's tech. And we did come back and set an all-time high with the S&P, and with the NASDAQ, we're coming off of recent all-time highs. And we can break that down a little further, and we're seeing something that's concerning us a little bit here. This is an equal weight S&P and an equal weight QQQ, which are the NASDAQ 100 stocks. They did not set an all-time high when the regular indexes were. So this is a negative divergence, showing that the broad market is still lagging behind the really big stocks at this point. We don't necessarily make decisions based on this. This is just something that we want to be aware of, and it's a negative divergence that we keep tucked away in the back of our mind. The FANG index is coming off setting recent all-time highs, but has been under some weakness, but it's still above its 50-day moving average. I keep this chart up here just in case we see some weakness, and if we continue to fall, I'll try to come up with other support levels here. Here's the Wilshire 5000, another broad market measure, and this is kind of interesting. In Friday's session, that was the low, which was right at the 50-day moving average, and we bounced up off of that and closed pretty much at the high. So that's suggesting on a broad market basis, the market came down to significant support and then was able to bounce up off of that. ARK has been a real disappointment for a lot of folks. It was really going up. It was all the rage, and everybody thought this was the greatest investment ever. Well, and then we hit 2022 and it was declining. We finally bottomed in 2022 with stocks, but ARK itself has not been doing all that well. It's in an uptrend, but not really moving all that much, and could actually see a death cross here if prices continue to fall. This is the all world index taking out US stocks. So this is looking at the global markets where we have seen some weakness, but still in an uptrend. And then we do a ratio between the S&P and that same all world ETF. When this is going up, that means that US stocks are outperforming the rest of the stocks in the world, even though it's been chopping sideways. But we are in an uptrend here. And here's a monthly chart looking at the S&P 500 and then another global index, showing how US stocks are outperforming. We see the moving average here, and we're above that, so that's positive. And even though we're seeing a little bit of weakness here with the momentum oscillator, that's something that might cause us a little bit of a concern. And then here's looking at bonds based on price, where we're still in an uptrend, but they've been really choppy lately. This is a world bond index. Talk about choppy. We're actually getting close to the point of seeing a death cross here with world bonds based on price. This is a longer term look at stocks versus bonds monthly, showing how stocks are still outperforming. Then we have a daily chart showing how bonds are underperforming. And then if you watch the weekly video, we also show that on a weekly basis, stocks are outperforming bonds. So we have daily charts, weekly charts, and monthly charts showing how stocks continue to outperform. These are high yield bonds. We also know them as junk bonds. They have been coming off of setting recent all-time highs. And these are more conservative bonds, which are still in an uptrend, but have a ways to go to get back to their all-time high. This is a ratio between the riskier bonds or junk bonds and more conservative bonds. And folks are still preferring the riskier bonds. They're willing to assume that additional risk to get a better yield on those bonds. This is a stock to bond correlation where we're seeing a kind of strong relationship between the two. That means if stocks are going up, bonds are usually going up, and vice versa. Sometimes this relationship is really strong. Sometimes it actually goes in the opposite direction. Here's the corporate bond index. Been chopping sideways for most of 2024, but still in an uptrend. And we look at some Fibonacci lines compared to the 10-year yield, not really getting close to any of these retracement levels. This is a longer term look at the 10-year yield where we're starting to go up into a higher range as far as interest rates are concerned. And that's got some of the market a bit concerned about things right now. This is another fib study with the 30-year yield, but we're not really close to any levels now. This is looking at the S&P 500, comparing it with the 10-year yield. This is showing how the S&P is outperforming, but we really have been chopping sideways for the most part. This, and I sometimes show this in the daily video, this is showing how bonds are underperforming stocks. When we see this ratio going down, and in a more positive environment, we want to see this ratio continue to fall. These are junk bonds all by themselves, where they are in an uptrend. Then we look at junk bonds and compare them with government bonds. It's showing how junk bonds are outperforming. This is the 7 to 10-year ETF. So these are bonds based on price, where they have been under pressure, but starting to go back up over the last few sessions. And bond prices going up and interest rates going down, right? In this kind of an environment that we're in right now is positive for stocks. Here's a daily chart of the yields across all the different maturity levels where we had been seeing interest rates going up. Then they started to come down, and the market was bouncing up during that time. And if interest rates can continue to fall, that would give more support to stocks. There's a weekly chart looking internationally with US, UK rates, German rates, and Japanese rates all increasing over the last week. We look at the MOVE index, which measures the volatility of bonds. Then we have the VIX, which measures the volatility of stocks. And they're having a pretty strong correlated relationship when we measure just volatility with each other. And here's a monthly chart of the 30-year based on price, and it's in a downtrend. But when we compare it to commodities, the price of bonds is still outperforming commodities on a longer term monthly chart. And we look at different sectors. And first I look at the sector all by itself. These are the material sector, and it's in an uptrend. Then we do a ratio between materials and the S&P, showing how materials are underperforming the S&P. Communication also in an uptrend, and one of the stronger areas when compared to the S&P. Energy, which is in an uptrend, and actually this is the incorrect chart here. This is not incorrect. We have been seeing where energy has been underperforming the S&P 500. It was coming back up, pulling back, but then energy had a pretty good week this last week. Most of the gains seen on Friday. This is the financial sector. Looking at it by itself, it's above its 50-day moving average. And it had been pulling back compared to the S&P, but could be showing a bit of a bounce and still in a longer-term uptrend. The industrials coming back up, but have not been able to get back above their 50-day moving average, and really seeing some recent weakness when compared to the S&P. Tech sector, this is the darling. This is what everybody does or loves. It came down to its 50-day moving average and then bounced up off of that and closed at the high in Friday's session. That could be quite positive for the market. Been chopping more or less sideways compared to the S&P, but in a good solid environment where we're really going up, the tech sector is usually outperforming the S&P 500. Staples, which have been in an uptrend, this is causing us some concern. This is another defensive area. We have staples, utilities, and healthcare are the big defensive areas. And when we see real improvements in those areas, that's a bit of a concern to us, where the staples came down to their 50-day moving average, but have been able to bounce up off of that. But when we compare it to the S&P, even though staples have been strong, they're still underperforming with this ratio. Real estate, which is in an uptrend, but when we compare it to the S&P, is really continuing to underperform. And real estate doesn't like a rising interest rate environment. Utilities breaking out to the upside, pulling back, but then saw a bit of a bounce on Friday. And they are underperforming longer term compared to the S&P, but you can see since about the middle of March, the utilities have really been coming back strong. And this is something we've been watching and want to keep an eye on to see if the market's turning more defensive. Here's an S&P to utilities ratio. When this is going up, that means the S&P is outperforming. When this is going down, that means utilities are outperforming. And we want to see this ratio really going up to be more positive. Here's healthcare, another defensive area, came back above its 50-day moving average in an uptrend. But when we compare it to the S&P, it's continuing to underperform. So this area is not really concerning us right now. It's mainly the staples and the utilities, and to a degree, the energy sector, because sometimes that's more offensive when it's going up because companies are doing better. And it can also be more defensive if geopolitical events are happening. Discretionary, the thing that makes life fun. This is in a longer term uptrend by itself, but it's really been under a lot of pressure, and Tesla's been causing a lot of that as it's underperforming the S&P. Semiconductors, a huge part of the tech sector. So we watch this industry group really by itself. It is in an uptrend. We saw some profit taking, but it really bounced back up in Friday's session. We do a ratio between energy and tech. When this is going down, that means energy is underperforming. We saw energy coming back, but now it's starting to underperform again, even though it bounced up on Friday. We look at growth stocks and compare them with the price of bonds, showing how growth stocks are outperforming. We look at the tech sector compared to the 10-year yield, showing how tech sector is not really breaking out compared to interest rates, but it's not necessarily falling apart. Here's an inverse of that, showing how the 10-year yield it's going sideways and not really breaking out compared to the tech sector. Discretionary to staples, we're actually seeing a recent death cross here, showing how discretionary are underperforming staples. A little bit of a concern to us. In more of a growth-oriented environment, we want to see discretionary outperforming staples. Here's an inverse showing how staples are now starting to outperform discretionary. Gold, which everybody's, yeah, look at gold, it's going to the moon. Well, on a ratio basis, it's just not really, it's in range bound here. Even though it's in an uptrend compared to stocks, it has been pulling back lately. So it's not been massively outperforming the way some may lead you to believe. And then looking at gold versus the dollar, we did break out above this trend line, but we've been seeing a little bit of weakness lately with the gold to US dollar ratio. High leverage loans, I really hone in on this. This has been holding up quite well and didn't even see much of a decline. These are very risky loans. And if the market and the economy were getting ready to fall apart, we would not see this in a solid uptrend the way we have both in 2023 and well into 2024. This gives us more confidence that the market and the economy is hanging in there for right now. Here's the NYSE composite, also in an uptrend. These are all stocks, also in an uptrend. Emerging markets showing some improvement here and in an uptrend. The Japanese Nikkei came back, set a new all-time high, fell back, and is now seeing a bit of an improvement. These are the micro caps, very small companies, also still in an uptrend. And we do a home builder study. I'm not going to go into this because we're not really seeing anything that's really all that loud right now. We look for divergences between the top chart and the middle chart, and we're not seeing that right now. The correlation is pretty strong. Bitcoin, which is for some, this is where everything resides as far as interest in the market. It has been pulling back, but it's still in a longer term uptrend. And we look at a longer term chart of stocks in China, which are in a downtrend. Excuse me. We're also seeing a bit of a downtrend with emerging markets, rolling over a bit in Europe, rolling over in Japan, and seeing some recent weakness in the US. InterMarket Analysis showing where oil is now dropped below gold as being the best performing asset going back to the beginning of 2024. The black line are stocks, and then we have green, which is the dollar, where the price of bonds continue to be negative. And then we look at some correlations. We compare the S&P 500 stocks with the dollar, and they're having kind of a strong tendency to go in opposite directions right now. We look at S&P to oil, where they're having a slight tendency to go in the same direction. And then the S&P 500 to the 10-year yield tending to go in opposite directions. So if interest rates are down, that helps stocks to go higher and vice versa. And then the tech sector to the 10-year, also this is dropping back to a neutral reading right now. And then the S&P to the 2-year yield, slight tendency to go in opposite directions. Then some long-term secular and cyclical studies. This is a monthly, excuse me, this is a monthly chart of the NYSE composite where we're in a longer-term uptrend. We're above an advancing moving average, and the Kopic curve, which is a momentum oscillator, continues to be positive. This is a daily chart, and we're continuing to go up with this different index that we look at. When it's going up, that's more positive. Then we look at a monthly chart of the S&P. and we're rolling over a little bit, but we could be seeing some improvement on a longer term basis with the momentum of the S&P 500. Then here's a daily chart of the S&P on top, and then a ratio between stocks and commodities showing how stocks are outperforming. And then a monthly chart looking at the S&P and global stocks showing how stocks are outperforming. And we're still pretty much flat with this other momentum oscillator that we look at. Then at the very end, I go through all the things that are positive. And my definition of positive is when the 50-day moving average is above the 200-day moving average. And I'm just going to go through these. The growth and value indexes by themselves, copper, the British pound to the dollar, gold, silver, the dollar index by itself, the CRB index, the big software companies, even though they're not really outperforming by any means, the mega caps, the FANG index, ARC, even though ARC has been languishing lately, low volatility stocks, staples, the Dow Jones Composite Average, bonds based on price. We're getting a little concerned about world bonds. They've been so choppy, they could see a death cross here if they don't improve. The tech sector, as well as semiconductors, high leverage loans, the Dow, the NYSE, and the Wilshire, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, all stocks. And then, okay, I didn't space this right. Emerging markets. And then the very bottom one is going to be Bitcoin. And then we look at the negative side where the 50-day moving average is below the 200. We have the Japanese yen compared to the dollar and the euro compared to the dollar. And it's a pretty short list right now. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you're having a great weekend, and I will talk to you in the next video.